How are farmland property taxes calculated from assessed value? If you own farmland or are considering investing in agricultural real estate, understanding how property taxes are calculated is essential. Let's break down the process in simple terms. First, the local tax rate, often referred to as the millage rate, is applied to the assessed value of the farmland. The assessed value comes from the land's appraised or use value, which focuses on its agricultural productivity. This means the value reflects how much income the land can generate from farming, rather than its market value for other uses. To determine the land's appraised or use value, experts estimate its income potential from agricultural activities. This involves calculating expected crop yields and average crop prices. Then, they subtract production costs, which include expenses like seeds, fertilizers, labor, and equipment. The net income is then converted into a land value using a capitalization rate. This rate indicates the expected return on investment for lenders and investors in agriculture. The result is a dollar value per acre that represents the farmland's productive worth. Next, many states apply an assessment rate to this appraised value. For example, if the assessment rate is 15%, only a portion of the land's productive value will be taxed. This approach recognizes the agricultural use of the land and helps keep taxes manageable for farmers. Once the assessed value is determined, it is multiplied by the local millage rate. 1 mill equals 1/10 of a cent, or $1 per $1,000 of assessed value. For instance, if the assessed value is $5,000 and the millage rate is 100 mills, the property tax owed would be $500. Additionally, some areas offer exemptions, credits, or special classifications for agricultural land. These can further lower the tax burden, depending on local laws and whether the land is actively farmed or used for conservation practices. Understanding this calculation is vital for farmland investors. The use value assessment often results in lower property taxes compared to market value assessments. This makes farmland more affordable to own and operate. Changes in crop prices or production costs can also impact the net income estimates, which in turn affects the assessed value over time. Local millage rates vary, meaning the same assessed value can lead to different tax bills based on location. Investors should keep an eye on agricultural income trends and local tax policies, as these factors directly influence the costs associated with farmland investments. In essence, farmland property taxes are calculated based on the land's agricultural income potential, adjusted by an assessment rate, and taxed at local rates. This method aligns taxation with the land's actual use and income, making it a key consideration for anyone involved in farmland investment or agricultural real estate.